Welcome to Let's Talk Cardano, presented by the Cardano Foundation. In each episode, we delve deep into the transformative world of blockchain technology. Join us as we explore how blockchain is reshaping industries from finance to supply chain and talk with some of the key pioneers at the forefront of this revolution. All right here on Let's Talk Cardano.
In this episode of Let's Talk Cardano, Kain Warwick breaks down the early days of DeFi, synthetic assets, and what he's building next. This content is not financial advice.
Kain, welcome to the podcast. It's an honor to have you here. You are an OG of DeFi. And in this series of podcasts, I would like to get novices, but also experts into the mechanics of the DeFi mechanics and to get them to understand a little bit better how things works, and whom better than you to go through stablecoin, synthetic assets, and so on. Welcome.
Yeah, thanks for having me.
Maybe to start with, what was your first touch point with crypto? What made you want to join the movement?
I think what made me want to join the movement was actually watching the DAO hack. It was the first time that I really understood how powerful smart contracts were, and you know, how many people were impacted and coordinating and trying to solve these problems. It was a kind of a strange situation to watch play out. You know, I'd been doing things in crypto before, but that was in my mind. I was like, okay, there's something really going on here.
Did you put any money in the DAO, or were you affected?
So I did put money in the DAO, but I also arbed the DAO token redemption. I bought a bunch of DAO tokens and was able to extract ETH. So one of my oldest wallets that I still have the seed phrase for was the wallet that I was doing the DAO ARB, the DAO token ARB on. I think it's must be 9 years old now, that wallet.
Interesting. And can you tell us how you got started? What was your first entrepreneurial project in blockchain?
So the first thing that I did that was kind of tangential to blockchain was when I started Blue Shift, which was this payment gateway where you could come in and make payments in Australia in local retailers. So you could basically make a cash payment to buy something in an online business. And at that time, I knew Asher from CoinJar. I'd met him a few years before, and I approached him and said, you know, we could sell Bitcoin for cash. You know, I knew about local Bitcoins, but obviously local Bitcoins was challenging for, you know, a bunch of reasons, right? That, you know, you got to meet someone in a dark alley with a sack of cash or whatever and hope everything goes right. This would be a lot easier. You could come in with $200 of cash, buy a Bitcoin over the counter. And at the time in Australia, the banks in particular, I mean, they're still bad, but they were really bad then. They were shutting down any business that was trying to do any crypto sales or anything like that. They would just shut their accounts down. And so that was the first time that I did anything that was involved in crypto, but we weren't the crypto side of that. We were the payment side. We were just facilitating payments for the crypto companies.
All right. And when did you do your first smart contract project?
Yeah, the first smart contract project was Havven. So, you know, we built the smart contracts for Havven, what became Synthetix, through 2017 into 2018, and launched in 2018 the original crypto collateralized stablecoin.
What was the MVP for Havven?
So we did a very short trial for about 3 months that was kind of locked down in what you could do within the system to test out the mechanics on chain and see what would happen. So it was like an alpha test, but test in prod on the actual Ethereum mainnet. And that went fairly well. I think we had probably 300 or 400 wallets participate in that alpha test. And then we rolled out the major release. So at the time that was called EUSD, that token, and it was an Ether-backed USD stablecoin. Then from there, once we'd kind of proven out that model that could work, we launched the Havven-backed stablecoin. So yeah, that was the next step.
In the timeline, was it parallel to MakerDAO? Was it before, after?
It was a little bit after. So Maker had launched in late December 2017, early Jan 2018. They obviously this was DAI V1. And it was ETH-backed CDPs. You put ETH in a collateralized debt position, and you could get DAI out. And that, at the time was going really well. So when we launched our EUSD token, I think this was about 3 months after the launch of Maker, and different design, slightly different design, different redemption mechanics, etc. But both of them worked fairly well. Obviously, this was super early, and so scalability wasn't yet a concern. We were talking, I think, like single-digit millions of dollars, maybe 8 figures or something like that. It wasn't the billions of dollars that it would become later.
So for the novices and the expert, could you explain us the basic architecture of the first synthetic ever on DeFi? Like, there's a smart contract, there's probably an oracle, it's over collateralized. Can you give us if you had to do a whiteboard of the MVP, how did it look like?
Yeah, so the early version was a single denomination token, so US dollar tracking token. It was crypto collateralized, so you would put endogenous collateral, the Havven token, into a smart contract, and then there was an oracle, which at the time was a centralized oracle, which maybe we'll come back to later. Centralized oracles are a bad idea, but at the time we didn't really have a choice. There were no oracles on mainnet, so we used this centralized oracle. Same as Maker, they had their own oracle system that they built as well, and you could borrow against the collateral, this USD denominated stablecoin. The interesting thing, I think, about both DAI and at the time what was called NUSD was that neither of them were sort of fiat backed, right? They were not algorithmic in the sense that there was some kind of algorithm that was trying to keep the prices in line. The actual incentive structure was what kept the prices in line. And in the case of NUSD, it was basically this arbitrage loop where I, as a borrower, would borrow stablecoins against my Havven collateral, and then I would sell them into the market at effectively whatever price I wanted, right? Like I might sell them below par with the US dollar if I chose to, but if I did, when I eventually had to pay back the collateral, I would lose money, right? So it was negative EV to do that. The incentives were pretty strongly against doing that, but. And this is the funny thing about crypto. You think you have a good incentive design, and then someone turns up and says, whoa. See, the thing is, I'm going to borrow against my Havens so I can buy more Havens. And I think the price of Havven is going to go up. So taking a 5% haircut, I don't care about that at all, because this thing's going to 10x. And so we had these degens who were like, this was the earliest version of leveraged looping I think we ever really saw, where they were levered looping. Even DAI yet, I don't think at this point people were yet doing that. But we had these degens who were leveraged looping Havens. So they would borrow Havens, get the stablecoin, sell the stablecoin for more Havens, put the Havens in, borrow more stablecoins, and lever up, which was pretty hilarious to watch. And so the peg was very loose at the time.
And how did you manage to keep the peg? Did you do
the peg got crushed down to like 70 cents because they were like, I'm happy to take a 30% discount on something that's going to be 10x or 20x.
Okay, so the bandwidth of the stability of the token the coin was okay.
Not amazing at first, and then over time, people got wrecked doing that. They got liquidated, and they kind of learned their lesson. They were like, okay, maybe this is not a great idea, and so the stability started to tamp down volatility and start to stabilize over time.
What was the main avenues or protocols for stablecoin to be used on? Was it any deck? None.
I mean, like you had IDEX and Ether Delta, both of which were fully ETH denominated. All of the markets were in ETH. And there were no stable coins at this time, right? Like USDT was on the Omni network. There was no ERC20 USD stablecoins except for DAI and NUSD in March of 2018. I think if I remember correctly, it was June or July of 2018 where both Paxos and Circle launched their stablecoins. So TUSD and USDC both launched around mid 2018. And then it started to shift. But even then, they had no liquidity. They weren't listed anywhere. It was prehistory.
All right. So you start with Havven. And then when did you get the idea of saying, okay, we can do stable dollars, why don't we do anything synthetic? When did you have this epiphany? Or
Yeah, so it's a funny thing, right? Because when we wrote the white paper, it was DevCon 3. We're finishing the white paper in late 2017. I want to say it was like November 2017 or something like that. And the white paper was done. And we'd had like 20 versions of this. We'd gone back and forth, and the engineers and myself and other team members fighting over different things. And I remember I was doing like the final version, and I introduced this little aside, I think on like page 5 or something, where I was like, look, the US dollar is an arbitrary denomination. You could denominate a stablecoin in anything realistically. And so eventually there is a world where we could extend this system to support multiple denominations. And the engineers were like, get this out of here. Like, do not put that in there. We have no idea how to do this. This is insane. You cannot write this. And I was like, whatever, it's fine. Don't worry about it. We'll figure it out later. And so it stood. It was in the white paper. We pushed it out. And then about 9 months later, I was rereading the white paper because I was looking at the mechanism and I was trying to figure out, what were next steps? Because it was clear to me that these fiat-backed stablecoins were going to dominate. It was going to be very, very hard to compete with them. And so I came across this little paragraph being like multi-collateral, multi-denominational stablecoins. And I was like, maybe we should look into this. And this was like July. And I remember we spent 3 days looking at the design, trying to figure this out. And it was crazy because it was one of those problems where you look at it from one angle and it makes sense. And then you look at it from a different angle and it doesn't work. And if you look at, you're kind of as soon as you go, oh, this will work, and then you kind of circle back around, you're like, oh, it doesn't work. And I remember one day we had this room in one of the old offices that had 4 whiteboards around the room, right? And I started on one whiteboard and we were writing up like, okay, what if we did this? What if we tried this? Next whiteboard, got all the way around. And then at the end, it was like, no, it doesn't work. And like just cross everything out. And so eventually, yeah.
What was the non-working argument? Because now looking back, obviously you can make it work, obvious. Right? But like what was it seemed like magic, but nevertheless now it's accepted that it worked. What was the accepted.
Yeah, I think the challenge was that within the system, you needed to have a way of tracking the debt that each person had that had to be resolved to a single denomination, right? So, if you had euro denominated debt, we needed to be able to track your debt. And so the problem wasn't so much like conceptually, can we do it? It was implementation level. How do we do this on chain, right? Like every time we thought we found a solution, it became this like unbounded calculation, this like loop over every single person's debt. And eventually I found a solution, which was basically we would track every single change that happened in the network. So the smart contract would track every single change. And we had this deterministic algorithm where if you looked at any given point between the start of the contract and where we were, you could just do a simple division to work out what the debt should have been. And it was like this very elegant solution to this complex problem. And as soon as I came up with that, it resolved everything and we were able to actually implement it. And then, again, as you say, like once something's working in practice, you're like, oh, that's such an obvious solution to this problem. But we spent months and months trying to solve it.
So can you explain, like M5, how the collateralization actually works? Maybe at the beginning, and if it's more complex now, we can go over it.
Yeah, at the beginning, it was pretty simple. You put stablecoins into the contract. Sorry, you put the Havven token into the contract, and you borrow stablecoins against it. We had ratio of Havens to stablecoins that was 5-1. So you could only borrow 20% of the value. So if you had $100 worth of Havens, you could borrow $20 worth of stablecoins. And then the system would track your debt and basically figure out how much you owed. But in a system that was single denomination of USD, there was no fluctuations there. The debt was constant. It was only determined by whether you'd borrowed or repaid, basically, right? And then liquidations. When we added denominational stablecoins, particularly Bitcoin and Ether, which were much more volatile, then all kinds of strange things kind of fell out of that, because you would borrow Bitcoin, and the pool of debt that existed, that was any person who borrowed was responsible for the entire pool of debt. So you and I, if we were 50% of the debt pool and someone was holding a Bitcoin token that went up in value, that meant there was more debt, because we had to pay off, we were short Bitcoin effectively if they were long Bitcoin. And us being short Bitcoin or short ETH or whatever, as the market was going up through July of 2019, as this system really started scaling up, the debt in the system tripled. So we had like $10 million worth of debt, and then a bunch of people use this to like lever up and go long ETH and Bitcoin. And it went from $10 million to $30 million with the same collateral. And so we had this issue of like debt inflation. There were all kinds of unintended consequences that came out of this.
That's super interesting. And how did you fix it, or is it not? How did you do the risk management?
Yeah, so we did a lot of modeling before we launched this. Probably too much, I would say. I'm a big believer in empirical data, but sometimes you get your face ripped off by empirical data, unfortunately. So we definitely got our faces ripped off a few times here. In the end, the solution to this was that we know that there was historical debt inflation in the system, but let's take even July, right? So July, Bitcoin and ETH went from $100 to $300 and back down to $100. Right. So in theory, there was no debt inflation, but depending on when you got in and out, you may have had debt inflation or debt reduction or whatever. So it's a very hard problem to solve, to figure out who was owed what or how much people lost. But in theory, all of the data is there on chain. Someone who's smart enough could write a program to go and ingest every single transaction inside of the Synthetix system since the Genesis block and when the contracts were deployed, and figure out exactly how much inflation there was, how much people bore. But we eventually kind of threw in the towel and said, look, everyone has had a lot of inflation. We don't know exactly how much. So what we're going to do is have a debt jubilee. And so last year we said, anyone who's been a staker for a long time, you can put all of your debt into a giant pool, and the treasury, the protocol, will absorb that debt. And we'll basically kind of have a debt jubilee. So you don't, after a year of holding it, you won't owe anything.
Can we do a concrete example? Say I put in 100 Bitcoin. That's a lot, but
yeah, back then it was fine.
Back then, exactly. Back then it was fine. 100 Bitcoin, and I can redeem 20% worth of it in stable dollars, right? Then the price of Bitcoin goes up, and then it goes back down to the original price when I put in the Bitcoin in. Why would I not be able to redeem the exact same amount of 100 Bitcoin?
Yeah, it's actually worse than that. So the issue was you're not putting Bitcoin into the contract. You're putting SNX tokens into the contract. So you put, let's say it's $100,000 worth of SNX tokens in, and you borrow $20,000 worth of stable coins. But you don't want to hold stable coins. You want to hold Bitcoin. So you swap those stable coins into Bitcoin. Now you have $20,000 worth of Bitcoin.
Yeah.
Let's call that, back in the day, 10 Bitcoin or something like that, right? But the price of Bitcoin doesn't stay at $2,000. It goes from $2,000 to $20,000. And now you've got $400,000 worth of Bitcoin.
Yeah.
Who pays you that money? Who's the counterparty to that trade? And the answer is, it's everyone in this pool that borrowed dollars. So it creates this really interesting problem where anyone who was borrowing against their SNX tokens was on the hook for the debt pool and also the denomination of the debt pool. So if everyone was long ETH and ETH was going up, you had to hedge that out by holding. It was a very complex problem, and it meant that really the people who participated were just like either very degen or very DeFi savvy or very financially savvy. It was not an easy product to understand.
Yes, yeah. I'm still trying to understand it. I ask.
We could be here for a long time. We could be. It
Uh,
doesn't exist anymore, right? We deprecated
yes,
all of this stuff.
yeah,
So this is kind of a historical conversation, I suppose.
yes. Maybe going back to one earlier point, oracles. You
Yeah.
mentioned you had a centralized oracle. What did you use at this time? Was it still a centralized oracle, or?
At that time, it was a centralized oracle. We switched in 2019. We switched half of our oracles to Chainlink. We still had some of our oracles that were centralized because they didn't have all of the oracle feeds that we needed. So I think we switched Bitcoin, Ether, and a few others, but we still maintained the gold and Forex oracles. And then eventually we handed over all of the oracles to Chainlink.
All right. We're going to do a whole episode about oracles, but for the novices, basically an oracle is providing the price in a decentralized manner. And
Well, maybe decentralized, maybe not, right? So I think the key thing about an oracle is a blockchain does not know what the price of eggs are today, or gold, or wheat, or anything that exists outside of the blockchain. So only assets that are native to the blockchain can a blockchain really track, right? So, if you have stable coins and you have ADA, right? You can figure out what the exchange rate is. You look at AMMs and you go, okay, ADA, it's 10, stable coins, 10 USD stable coins to 1 ADA. That's what the AMMs are saying, right? That's the price. But that's the price only in one block. Maybe the next block it changes, and maybe then it changes again, and then it goes back. And so it's moving around all the time. So what is the real price? At any given moment, you don't really know what the price is. You only know what the historical price is. And so when you have a problem like this, the solution, particularly for things that are not on the blockchain, right, is to go and ask the world. And this is a hard problem, right? Like in traditional finance, if you go and ask the world what the price of something is, you have very interesting results, right? One of the most interesting examples of this is LIBOR, right? This rate, the London interbank borrow rate. Basically, they would call up a bunch of banks and say, if you were borrowing X amount of dollars, how much would it cost you to borrow them for N amount of days, right? And the banks would say whatever they wanted. And it turns out that sometimes it was a day where you were short interest rates and you're like, oh yeah, it's super expensive to borrow today, right? And so you call up all these desks. So if you call up, and this is the same problem, funnily enough, in eggs, right? If you call a chicken farmer, you say, hey, what's the price of eggs lately? Chicken farmer is going to be like 8, 9, let's call it 12 cents. How about 12 cents, right? And so if you want to get an accurate price of anything that's off chain, you need to go and ask a bunch of people who have an incentive to tell you the correct information. And then you need to find a way to aggregate all of that information. So maybe you don't call one egg farmer, you call 100 egg farmers, right? And you have some mechanism where if one of the egg farmers tells you 12 cents and everyone says 8 cents, you go and steal some of his chickens or something. I don't know, some kind of punishment, right? So everyone's incentivized to give you the real answer. So everyone converges on an answer. You say, okay, it's 8 cents per egg. Cool. So then you have to take that information and aggregate it, bundle it up. You get the answer, and then you got to push it to the chain so that the chain knows, yeah, okay, if I want to know what the price of eggs are, I go to this contract and I can read a price of eggs, and I find out that right now, today, this second, the price of eggs is 8 cents. Tomorrow, maybe it's 9 cents, then it's 10 cents. But today, right now, on the chain, it knows the price. That's what an oracle does. And you can do it for anything that exists in the world. You can do it for gold, for wheat, for eggs, whatever.
And did you do any time delay redemption mitigation for your Synthetix?
I wish we did.
Okay.
I wish we did. So we had an issue with our centralized oracle at one point. This was mid-July 2019.
Because maybe there's
Sure.
also a question of you might know the price of eggs.
Yeah.
But if somebody comes along and say, I want 1 billion eggs, there's a different price to it, right? It's a bit more.
Exactly. Yeah.
Yes.
And so we had this problem. We said, okay, we have foreign exchange tokens, right? We had rubles, we had cable, we had euros, we had Korean won, we had all of these different FX tokens that you could hold for reasons. And we had 3 different FX providers that we were aggregating the prices of and pushing those in through our centralized oracle. And we didn't have very good fail safes on this oracle because it was a centralized oracle that was kind of cobbled together, right, in 2018. And one morning, and this was really diabolical, right, because it wasn't just like the price was wrong, the price flipped back and forth. And so one of the providers provided an incorrect price on the Korean won that was 4 orders of magnitude off. Now, if that had happened, okay, fine. It thinks that the price is too low. Only someone who, was either in Korean won or whatever could take advantage of that because, the exchange rate's now shifted. You go in, you go out, you don't get anything. That's the new exchange rate. The problem was the exchange rate shifted and then it somehow went back to the real rate. And then it went back to the wrong rate and back to the real rate like 5 times. So 5 times 4 orders of magnitude, you can imagine how bad the problem was. Now, in theory, no one would notice this, except there was one guy who was running bots that were arbing the prices across these FX tokens. And his bot went, oh, this is a good exchange rate. I'm going to exchange into it. And then out and in and out and in. And in the end, he ended up with 11 billion synthetic ether tokens.
And what did you do about this?
Well, yeah, which is more ether tokens than is on the Ethereum blockchain, right? Yeah. And so we got in contact with him via Reddit and we had a conversation. We said, okay, like we've halted the protocol. We paused the protocol and we said, look, you can't get out. We'll give you a bounty. Like, you found a bug in the Oracle flow. We should have had some, hard limit on the delta or whatever. So we'll pay you. And so we paid him 50 ether. And he was a bit of a dick about it and continued to try and exploit the Oracle. And then eventually we built a mechanism that wrecked him by him trying to exploit the Oracle. So this was like a very cat and mouse game that ran for 6 months between us and this. Now, these days, if you were doing this, you go to jail. It's pretty crazy, right? That in 2019, you could just be out there in the world doing these kinds of Oracle manipulation strategies and stuff, and it's totally fine. But there's a bunch of people who 2021, 22, 23 got arrested for this sort of thing. So this was very much the Wild West.
Interesting. Did you make a job offer to this guy, or he
was too much. He was not a fun guy. I didn't like him. We weren't friends.
Maybe in TradFi, all of these exist, right? What was your frame of thinking? We are trying to do these, ETFs or CFDs, or which books did you have open on your desk at the time?
Yeah, I think there was some sense, especially in the early DeFi days, that it was not just possible, but also maybe optimal to look at all of these problems from first principles. We had this new financial plumbing. We could try things in a different way. And I think the primary difference that we had in DeFi over TradFi, and I had a lot of friends who had been in fintech startups and stuff. And fintech startups, there was 2 decades of honestly not much progress in fintech startups, really. They didn't actually achieve very much at all. And the reason why is because they were kind of attached to TradFi, and TradFi is very opaque and not open. And, you go to a bank and say, hey, is there any chance I can get access to your account API so I can do some analysis on all your customers and improve the product or whatever? And no, obviously not. You can't get any of that data.
I worked at UBS. I did a robo advisor for them, and it was all engineering in the front end or in the kind of pulling some magic on top of the back end that was it. Nobody wanted.
It was all COBOL or something, right? Some legacy.
It was COBOL. Yeah.
Yeah, exactly. And so, there was, even if the bank was yes, this is exactly what we want to do. They're here's this giant mess of 50-year-old COBOL for you to deal with. And you're well, that's, so I think there was a sense in early DeFi that we kind of had this obligation to like rethink everything from first principles, which was not amazing in a lot of ways because we blew ourselves up in very obvious, anticipatable ways by not learning the lessons of TradFi. But we also came up with some stuff that I think at least has some novelty and some differences because of the structure of how DeFi works versus TradFi. You know, things like composability, this idea that like all of these different things, you know, could be combined permissionlessly. That's just not something that you would kind of figure out from doing TradFi stuff.
All right. So we touched the early architecture. You mentioned the collateralization. How did things evolve? How are things now? How does it look like today? You mentioned already the composable architecture. Maybe we can also go into that. But how did things evolve in terms of Oracle and the...
Yeah, we switched oracles several times. We ended up going with Pyth oracles. We also rolled out multiple synthetic products as well. So we had binary options, like synthetic binary options. We had synthetic short tokens, synthetic leverage tokens. We tried a bunch of different things to see if we could get product market fit. We eventually created a perpdex, which the first version of was somewhat constrained by being fully on chain and you know there were other issues there. We then iterated on that. We created like 2 or 3 different versions of the perpdex. We tried to run things on L2s. We built our own L2. Where we've converged though is that a hybrid off-chain on-chain architecture for a perpdex is the optimal solution. And interestingly, the synthetic assets that we used to issue, the spot synthetic assets, we sort of came to this realization that they were parasitic to the perpdex because you were paying nothing. There was almost like free directional exposure via these leveraged tokens, and you're paying no funding rate, even though it was a synthetic asset. And so we decided that it would be better to deprecate them and just lean into the exchange. So we still have a stablecoin. We still have this crypto collateralized stablecoin. We no longer allow people to directly issue the stablecoin to borrow against their own individual CDPs. So the protocol has evolved in a bunch of different ways, but the focus is and has been for the last 2 or 3 years on building the best perpdex that we can. And I think that, you know, the last 6 months in particular, we've made a lot of progress there because we've realized that, you know, trying to build a fully on-chain DEX has trade-offs. Hyperliquid is very good, but you know there's trade-offs there.
Can you explain in simple terms what is a perpdex?
Sure. So BitMEX in 2014 invented this concept of a perpetual future. So a futures contracts are you and I agree that you will pay me a certain amount of money or deliver to me a certain amount of an asset for a certain price in the future. In 3 months, you're going to deliver to me, you know, 100 bushels of wheat, right? And we agree on a price. And then, you know, if you're a farmer and you're about to produce 1,000 bushels of wheat, that's great for you because you can lock in a future price, right? If I know that I'm going to go on a long shipping voyage or something like that, I'm going to use, you know, 100,000 liters of fuel, but I'm not leaving for 3 months and I've got to prepare for this. And, you know, fuel maybe is quite volatile. I might want to lock in the price, the future price of fuel, right? So traditional finance came up with this idea of futures contracts so that, you know, for commodities in particular, people could agree on a future price for a thing for delivery so that, you know, they could hedge out their exposure to price fluctuations over that period of time. And there's a cost to that, et cetera. One of the challenges is in futures, standardizing contracts. So I turn up and I'm like, okay, I need 100,000 liters of, I don't even know, like some petrol, right? You know, petrol for my tanker in 6 months' time. So on like the, you know, 22nd of May, 2026, right? That's insane. Like no one's going to do that. How do I find the counterparty that's like, oh yeah, I'm going to have 100,000 liters of fuel to deliver on that day. So what TradFi did is they said, well, let's slice up these contracts, turn them into like not 100,000 liters. That's an arbitrary thing, but you know, how about 5,000 liters of a certain type of petrol, maybe it's, crude oil or whatever that's unrefined. So we'll all agree on some standard contract, right? For gold, wheat, pork bellies, whatever it is, and we'll do them on a monthly basis, not on some particular date, right? And so every month we roll these contracts, and if you are not yet ready to get the delivery of the thing, you roll the contract, and then eventually 3-6 times you roll the contract, then you get the thing. Cool. Then Arthur from BitMEX was like, rolling this all seems kind of dumb. I just want to bet on the future price of Bitcoin forever. Why would I roll it, right? And so the reason why we roll the contracts, the reason why they have to converge is because if they don't, then the price of the pork belly contract could not reflect the price of actual pork bellies, right? They could completely diverge. And so Arthur was like, okay, we don't want the prices to diverge so that, my paper Bitcoin contract on BitMEX is trading at $1 million and real Bitcoin's trading at 10K. That would be stupid, right? So what we'll do is we will track the price and we'll create a funding rate. So if people are too bullish on Bitcoin and too leveraged directionally on Bitcoin, it's going to cost them a lot of money to hold the contract open, and the price will get dragged back to the real price, right? The further away, the more it costs. And this was like the most genius invention. And, perps took over all of crypto trading. And so this perpetual contract that doesn't expire, doesn't roll, there's no cost to roll it to a new contract, just goes forever. With a cost, obviously, there's a funding rate to keep it open, is just the smoothest way to have a leverage exposure to an underlying asset that you could make so far, that the world has figured out so far. This is like the optimal thing. And so then in DeFi, we were like, BitMEX is cool, but you got to trust Arthur. Like, he's got all your money, he's got all your Bitcoins. What if he rugs you? Like, whatever. And so we were like, why don't we make a permissionless version of this where you don't need to worry about that? You don't need to give someone your Bitcoins or give someone your collateral. And like a lot of DeFi things, the first few versions were pretty shitty and not as good as BitMEX. And they weren't that competitive, but they were good. And then eventually we got to the point where I think Hyperliquid was like, we've built a thing that is as good as a centralized exchange, but is permissionless. And so that's kind of the gold standard now for perp dexes. And that's what everyone's kind of working towards. But at the end of the day, all the perp dexes are trying to take on centralized exchanges. Centralized exchanges are still 95% of the market. So the delta between perp dexes and centralized exchanges is still huge.
All right. So to recap, the perps are essentially the easiest way for people to leverage trade on or speculate on the price of crypto, right? That's
and now also stocks, right? Like, Hyperliquid has Nvidia, Google, single stock leverage.
And that's where Synthetix interlinks with perps, right? You can go on a platform that has no exposure to Tesla or Bitcoin or Ethereum and trade those assets, which is kind of mind blowing, right?
It's a good innovation.
Yeah. How is risk managed in all of this? Because now you already have all the risk of synthetic asset, and on top of that you have this leverage trading, right? If there's, how does the system respond in high volatility times?
Well, like anything, it's trade-offs, right? And this has been an interesting recent debate between different exchange designs, right? Because at the end of the day, there is somewhat of a zero-sum relationship between the traders on the exchange and the exchange itself. So the goal of the exchange is to try to remain solvent. You're not a very good exchange if you blow up. So, and blowing up even once is bad. You probably don't recover from that. And so you have to make a decision as an exchange as to how much risk you're willing to take. The more risk you take, arguably the safer it is for traders, right? And the harsher you are on traders, the faster you liquidate them, the faster, the more aggressive your systems are when it comes to position management, the more cost that a trader bears for keeping a position open, right? These are like the hidden costs of trading on a venue. And so there's a really interesting debate going on about how do we manage these things? What is the balance? What's the right balance? What's interesting is post BitMEX, no one really innovated at all. like every single centralized exchange just cloned the BitMEX funding model, everyone was running like 8-hourly rolling funding rates for like no particularly good reason. A few people changed like, oh, we're going to do 2-hour funding rates, but there was almost no innovation in perps. And then, we had these hybrid perp AMM dexes that had effectively like an insurance fund, like an active insurance fund that was taking the other side of trades at the margins. And that was a pretty big innovation because prior to that, the BitMEX solution was accumulate a giant pile of Bitcoins, the insurance fund, right? And if something really goes wrong, we've got 100,000 Bitcoins, so we'll figure it out. But there was no mechanism, there was no direct connection between those Bitcoins and the safety of traders, right? Whereas like, a lot of these hybrid AMM dexes had kind of intrinsic insurance funds. So Hyperliquid has HLP, which acts as like a backstop to traders to make sure the traders get paid.
Yeah, you would think that the perfect design would have kind of a delta neutral, or like whatever happens, everybody can be made whole and the protocol makes revenue. Maybe going back to the building blocks architecture for DeFi, is it happening? Are debt pool and oracles and vaults all working together, or is still work in progress?
I think a lot of the primitives are fairly well established and have quite a bit of Lindy. Like they've survived for long enough that people can trust them. Not perfectly. We still have issues like Balancer, where 4 years later there was a hack and it blew up and lost over $100 million. So DeFi is still not zero risk, even with the large scale protocols that have survived for a long time. But the likelihood of something like that happening with Aave seems to diminish every day. Because there's a giant bug bounty sitting there, billions of dollars if you can find a way to exploit Aave. So, not to say that it's not possible, but the likelihood diminishes over time. So you've got things like Aave, you've got things like Maker, what's Sky now, that has, these yield bearing stablecoins. You've got things like Athena that's built tokenized. Yeah, Morpho. So you have a lot of primitives that I think are fairly well established, and the interlinking between them is still being kind of worked out. You have things like Chainlink, Wormhole, Pyth, ways of synchronizing blockchains and synchronizing the real world to blockchains, CCTP, CCIP. There's a number of different protocols for like chain synchronization. We're still, I think, fairly early in this, but the infrastructure is getting better every day.
Does Synthetix use any debt pool, or is it its own separate?
Yeah, so Synthetix now, the exchange has a similar approach to Hyperliquid with the liquidity pool. So we have SLP, which is the backstop for the exchange. And again, I think this is where DEXs are arguably better than centralized exchanges, because there is a lot of transparency with the exchange running on chain. You can look at how much value is in the vault, what's your risk of total loss, what's the potential kind of payoff curve if something goes really wrong. There's a lot of data that you can get very transparently that you won't get from Bybit, for example, right? No one knows how much volatility can Bybit absorb before something goes really wrong.
Do you think you need your own token for Synthetix or for a perps exchange?
I don't think you need a token for a perps exchange, but it can be helpful in a lot of ways, because tokens are really a coordination mechanism. So if there's a perp exchange that's making a lot of money, how do you distribute that money? Who owns it? Where does the money go? By having a token, you have a very clear mechanism and vector for distributing those funds.
How did you leave the Terra Luna, let's say, event, and was it Havven still around? How did that? Because that's the most criticism, or like why do you need a token? And then you think of Terra Luna, right?
So there's an interesting story here. So I knew Do quite well. I met him in 2018 in Korea, and when I met him, we were sitting on stage. It was the first time I'd ever met him. We're sitting next to each other on stage. And this was, stablecoins were like the meta at the time, right? I think maybe Nader from Basis was there. There was a Maker guy that was on stage. So there was like 6 or 7 stablecoin projects on stage on this big panel talking about stablecoins. And the moderator goes, so tell me the design of your stablecoin. And Do's like, well, our stablecoin works like this. We take our token and you put it into a CDP and you borrow against it. And my co-founder is sitting in like row 3, looking at me, and I'm looking at him, and I'm looking over at Do, and I'm like, this guy is describing my protocol. I've never heard of this guy. What is going on here? And I got off stage and I was like, hey, the thing that you've described sounds really similar to Havven. Like, what's the origin of this? And he goes, oh, yeah, we love the Havven white paper. We've read it many times. And I was like, okay, cool. But the interesting thing about Terra was they took a lot of the designs of like Maker, Havven, and some of the early even BitShares, and they just juiced it up to a point that it was insane, right? So we had this view that like, if the stablecoin depegs, you can't bring it back to peg with endogenous collateral. You have to let the market reset itself, flush out the leverage, and rebuild, right? And so that was always like, this could happen if there is a depegging event. And Synthetix, had like 4 or 5 depegging events, and it always comes back eventually. The market kind of finds a new equilibrium because the people who have issued debt are always on the hook to pay back that debt. At some point, they're going to want to get their collateral back and pay it down. So it might take time. But the Terra solution was just print more tokens. It'll be easy. If the thing depegs, you just print more tokens, and it's like crazy death spiral risk, right? Yeah. And so like from the moment that I was talking to Do in 2018 and he told me this, I was like, this is pure insanity. Like, they've taken a thing that is already extremely risky and very experimental, and they're like, hold my beer. I think I can make this even more experimental. And throughout 2019, I had a bunch of investors and stuff who were like, that Do, he's doing very well over there in Korea. I don't know if you realize, but Mirror and Chia, their 2 protocols that they had at the time, were apparently like running all of e-commerce in Korea, right? There was this story of like Chia was like doing tens of billions of dollars in won of trading. Anyway, by the end of 2019, it's basically over. Like, Terra doesn't exist. It's kind of dead. People have forgotten about it. There were several other stablecoin projects that had died. Havven Protocol died. And so I was kind of a little bit grave dancing, like, okay, well, the smarter designs survived, whatever. And then in like the beginning of 2020, they launched Mirror Protocol, and they offered this very high, we had incentives, right? Like we had this yield farming incentive. And so classically, right, Do turns up and goes, I'll clone this thing, but juice it up and make it crazier, right? And so he's like, we're not going to pay out the incentive in a volatile token. No one wants a volatile token. What they want is the incentive in the stablecoin. So we'll pay out an incentive for people to trade on Mirror Protocol in stablecoins, their own stablecoin. And people loved it. And they started trading, and it was crazy. And this thing that was dead just kind of rose from the grave and became this like insane $60 billion monstrosity, and then collapsed on itself. So good times.
Any funny anecdotes on the latest October 10 crash and hacks and depegs? Anything? Any anecdotes you can share?
I don't know of anything yet that's kind of come out of that, funnily enough. Obviously, a lot of people got wrecked in that period. But yeah, it's not 100% clear what long-term... This is, 3 Arrows and Terra and those collapses, FTX, et cetera, in 2022, they took a bit of time. I mean, Celsius and BlockFi, like all of these guys that blew up, it took a bit of time from like the volatility to then the blow up. So there's still possibly some bodies that are yet to float to the surface. But the further we get away from it, the more it seems like it was actually just retail degens who got their faces ripped off, unfortunately.
So what's next for you? You're working now on Infinex. Can you tell us a little bit about it and how you went from Havven to Synthetix and now Infinex?
Yeah, so I think the origin of Infinex was trying to solve some of the DeFi problems that I think had held us back, the UX in particular. This idea that we had all of this cool stuff, but it was very hard to access. You had to be quite technical. We had this view that like we were going to educate people into being early adopters, right? So there was a group of like 5,000 early adopters who got into DeFi, got really excited about it. And we sort of ran out of people. And then we're like, we just need people to be a bit smarter. We'll teach them some cool stuff, and then they'll all come and do this crazy DeFi stuff. And it didn't really work. And so in 2023, I was like, okay, maybe we need to try something different. Let's build a better user experience and see if we can bring DeFi to people rather than trying to bring people to DeFi.
I downloaded the app. I think the onboarding is one of the smoothest I've seen. It's a very good.
Thank you.
Thank you so much. And that was super insightful. And hope to have you on a second time for the deep dives.
Yeah, Oracles might be too much PTSD for me, but maybe a different show. You can bring me on for a quick clip.
All right. Thank you, Kain, and have a good day.
Yeah, thank you. You too.
Thank you for joining us on Let's Talk Cardano. For more insights and deep dives into the world of blockchain, don't forget to subscribe and reach us at cardanofoundation.org, where you'll find extra resources and content on all things blockchain. Leave us a review wherever you enjoy podcasts. Follow us on social media and stay tuned for more coming soon.